Natural gas prices declined over the past week, breaking down sharply to test a key uptrend line before bouncing. This move reflects ongoing pressure as the market reacts to shifting demand expectations, with milder U.S. temperatures reducing weather-driven support. While the rebound off trendline support is notable, the broader setup still favors selling pressure. The $4 level remains a strong resistance zone, while $3 could be the next downside target. Seasonally, this time of year tends to weigh on prices, adding to the bearish bias. If we zoom out a bit, it's hard not to notice that natural gas prices are riding well above their historical average of $3, mostly on the back of high hopes, or hype, around booming LNG exports later this year. But when you actually break down the market fundamentals, those fears start to look more than a little exaggerated. Let's dissect the three core components of this supposed supply crunch: LNG export capacity, pipeline infrastructure, and production potential. First up, LNG export capacity. The three headline projects are already about 50% operational, with another 3.2 billion cubic feet per day expected to come online by year-end. That would bring the total added LNG demand to around 6.4 billion cubic feet per day. So yes, exports are growing, but half of that capacity is already priced in. Now, let's look at pipeline capacity, which gets far less attention than it deserves. Currently, 4.5 billion cubic feet per day worth of new pipelines are already moving gas toward LNG terminals, with another 7 billion cubic feet per day scheduled to start flowing by the end of the year. In other words, infrastructure isn't the bottleneck. And finally, production, the linchpin of the whole equation. Output has already increased by 5.6 billion cubic feet per day year over year. More notably, gas rig counts have surged by 10% in recent weeks. Yet production hasn't surged just yet, likely because energy companies are enjoying the current price levels and don't want to flood the market prematurely and send prices crashing back to $2. Still, they're more than ready to ramp up output once the rest of the LNG terminals go live, with the potential to add up to 10 billion cubic feet per day. So when you add it all up, we're looking at a market where 3.2 billion cubic feet per day of new LNG demand is already absorbed, pipelines are more than ready, and producers can flip the switch on a massive wave of new supply the moment prices or contracts justify it. Bottom line? The fundamentals look a lot more bearish than bullish. But don't tell that to the speculators, who seem to think we're on the cusp of a gas shortage of biblical proportions. Meanwhile, competition in the global LNG market continues to heat up. Canada's LNG Canada project began production just a week ago and is expected to add around 2 billion cubic feet per day to the market by year-end. On top of that, an LNG carrier has arrived at Russia's Arctic LNG 2 facility, suggesting that loadings from the heavily sanctioned project may soon resume. This could introduce another 2 billion cubic feet per day of supply into the global market over the coming months, competing directly with higher-priced U.S. gas. The result? Even more pressure on an already oversupplied U.S. market, with the potential to push prices significantly lower. From an analytical standpoint, the recent sell-off appears to have been somewhat overextended, prompting a technical rebound. However, any upward movement at this stage is likely to be met with skepticism and could present a selling opportunity, particularly if momentum shows signs of stalling. The $4 level remains a significant resistance zone and is unlikely to be breached without a clear fundamental catalyst. Even if prices approach that level, it would likely invite increased short interest, reinforcing downside pressure. A failure to sustain gains could result in a renewed decline, potentially pushing the market below the 50-week moving average and signaling further bearish momentum. Please like, subscribe, and comment to support the channel. See you in the next one.